Yo, buddy, and what's up, everyone? Real talk. Do you actually think the money sitting in your bank account is yours? Like, physically sitting there, waiting for you?
Oh, buddy, yeah? That's kind of the whole point of a bank, right? You put it in, it stays there.
Bro, it's not there. None of it is. And today we're going to prove it with receipts. Stick around, because once you see this, you can't unsee it. The number in your app is a promise, not cash. Open your banking app right now. See that number? Let's say it's $2,400. Here's the uncomfortable truth, that money doesn't physically exist anywhere. It's not in a vault, it's not in a safe. It's a number in a database, and it only stays real as long as everyone around you keeps believing it is. Don't believe me? Let's look at what happened in March 2023. Silicon Valley Bank, one of the most hyped, prestigious banks in America, the bank where literally half of all US tech startups kept their money, collapsed in 48 hours. Not because it was a scam, not because the CEO ran off to the Bahamas. It collapsed because people simply stopped trusting it and started withdrawing their cash at the same time. $42 billion was pulled out in a single day. The bank couldn't cover it. Game over. Thousands of companies, real companies paying real salaries, suddenly couldn't access their own money. One day, thriving. Next day, frozen. That's not a glitch. That's the design. How the trick actually works. Here's how this started. Centuries ago, before Venmo and crypto and contactless cards, people stored their gold and silver with goldsmiths, basically the security guards of the medieval era. You'd hand over your gold, they'd give you a paper receipt. You'd use the receipt to buy stuff, because it was lighter and easier than carrying actual coins. Smart. Simple. Fine. But then the goldsmiths noticed something sneaky. Nobody ever came to collect their gold at the same time. So they started issuing more receipts than the actual gold they had, double the gold on paper, triple it. The profit was insane. And as long as everyone didn't show up at once, nobody noticed. Sound familiar? That's literally what banks do today. Except instead of gold receipts, it's your checking account balance. And instead of one shady goldsmith, it's a $23 trillion banking system. The modern version is even wilder. Here's where it gets really crazy. You might have heard the term fractional reserve banking, the idea that banks must keep a fraction of your deposits on hand, like 10%, and can lend out the rest. That was already wild, but at least there was a rule. In March 2020, the Federal Reserve removed that rule entirely. Reserve requirements in the US? Zero, zilch, nothing. So what does that mean? It means when you deposit $1,000 into Chase, Chase is not legally required to keep any of it. They can lend all of it out. And when that borrowed money gets deposited somewhere else, that bank can lend it all out too. Your original $1,000 gets multiplied through the system into thousands of dollars of debt, all backed by nothing except confidence. And here's the kicker. When a bank gives you a mortgage or a car loan, they're not pulling existing money from a vault. They're literally creating new money by typing numbers into a computer. That loan didn't exist before you signed, now it does. And now you owe interest on money that was conjured out of nothing. The real-world receipt, 2008, all over again. In 2008, the same trick broke spectacularly. Banks had been multiplying mortgage debt like crazy, bundling it into financial products nobody fully understood and selling it around the world. When homeowners started defaulting, the whole chain of promises snapped. Lehman Brothers, a 158YEAROLD firm, gone in a weekend. $700 billion taxpayer bailout. Millions of ordinary people lost their homes, their jobs, their savings. The banks that caused it? Most got bailed out, paid bonuses, and kept going. Fast forward to today. In 2024 and 2025, we're seeing regional banks in the US under pressure again. Commercial real estate loans are going bad. Office buildings are empty thanks to remote work, but the loans backing them are still on the books. The FDIC's list of problem banks quietly grew throughout 2024. Nobody's screaming about it on the news yet, but the pattern, the same.
Okay, wait, hold on. So you're telling me that when I got my student loan, the bank didn't actually have that money? They just made it up?
Exactly. The moment you signed, new money was created, and now you're paying interest on something that didn't exist before your signature. That's not a conspiracy. That's literally how it's documented to work.
That's actually insane, wow, my friend. So the entire economy runs on vibes, like collective belief?
Vibes. Literally. Jason's right. The modern economy runs on confidence. That's not an exaggeration, that's the technical term economists use. And when confidence breaks, the math doesn't save you. Think about it this way. In 2022, the crypto exchange FTX had $16 billion in customer assets on paper. When a competitor leaked that their balance sheet was basically fake, people started withdrawing. In 72 hours, $6 billion left the platform. FTX collapsed. $8 billion in customer funds, gone. Sam Bankman-Fried went from next Warren Buffett to convicted felon in about 14 months. Now, FTX was crypto. Different system. But the psychology, identical to a bank run, the confidence disappeared, and so did the money. Inflation, the hidden tax you never voted for. Here's another layer people don't talk about enough. Every time banks create new money through lending, there are more dollars chasing the same amount of stuff. More dollars, each dollar is worth less. That's inflation, and it's not random. It's baked into how the system works. Between 2020 and 2023, the US money supply exploded. The Fed printed trillions to cover COVID stimulus. Banks multiplied that through the lending system. And then we all acted shocked when inflation hit 9.1% in June 2022, the highest in 40 years. Your $100 in 2020 had the buying power of about $83 by 2023. That's not bad luck. That's math. Your savings were quietly taxed by inflation while sitting in your account, earning 0.01% interest at the bank, while the bank lent your money out at 7%, 8%, 20% on credit cards. Who wins in that setup? Not you. The global version, it's not just America. This isn't a US-only problem. In the UK, Credit Suisse, a 167 YEAROLD Swiss bank, collapsed in March 2023. Emergencies sold to UBS for pennies. In China, dozens of rural banks froze withdrawals in 2022, sparking protests. Customers showed up to get their money, found locked doors, and got met with riot police instead of cash. Turkey's inflation hit 85% in 2022, meaning prices nearly doubled in a year. People's savings didn't double, their purchasing power got obliterated. In Argentina, inflation crossed 211% in 2023. Workers were getting paid and sprinting to spend the money before it lost value by the end of the week. This is what happens when the system of debt-backed money breaks down. It doesn't break evenly. The people with hard assets, land, gold, stocks, real estate, ride it out. The people with cash savings, wages, and fixed incomes, they get crushed. So what do you do with this? Here's where this goes from scary knowledge to actual strategy. Understanding the system means you could stop playing by rules that were designed to keep you behind. First, cash savings in a low-interest account is a guaranteed slow loss. If inflation runs at 3-4% a year and your savings account pays 0.5%, you're losing 2.5% of your real wealth every single year. That's not saving, that's slow-motion losing. Second, debt is the bloodstream of the system. The system literally cannot function if everyone pays off their debt. But that doesn't mean you should stay in debt. It means you should be ruthless about high-interest debt, especially credit cards at 29% April, which is legalized wealth extraction. Third, real assets beat paper promises over time. Throughout every financial crisis in modern history, 1929, 1971, 2008, 2020, people with ownership stakes in real things came out ahead. Not always immediately, but over time, real estate, index funds, commodities, skills that can't be inflated away. That's how you build a floor under yourself. Fourth, know what FDIC insurance actually covers. In the US, your deposits are insured up to $250,000 per account. That helped during SVB. Regular depositors were eventually made whole. But it took emergency government action, not the automatic system, and not all countries have equivalent protections.
Man, I feel like I just got a financial red pill. Like I've been grinding and saving and I didn't even know the game was rigged from the start.
It's not about the game being rigged, it's about knowing the rules nobody told you. Once you know how money is created, you stop being a passenger in your own financial life and you start making moves with your eyes open.
Alright, so step 1, stop leaving all my money in a savings account earning literal pennies. Got it. What's next?
The takeaway you can actually use. Jason's question, what's next, is exactly the right one. Because this isn't about doom, the system is flawed, yes. But it's the system we're all operating in, and the people who understand it will always be better positioned than those who don't. The medieval goldsmiths figured out that confidence was more powerful than gold. The modern banking system scaled that trick into a $400 trillion global financial machine. Every financial crisis you've seen in your lifetime, and you'll see more, is just a moment where that confidence cracks and reality briefly catches up with the promises. But here's the thing, crises don't end the story. They redistribute. Every crash has winners. They're just usually the people who understood what was coming. The number in your banking app is a promise, not cash. Act like it. Build ownership. Understand debt. Keep learning. Hit subscribe, because Volky has the answers, and we're just getting started.